Today, I'm going to lay out a simple thesis. This isn't about whether it goes back to 120. It's about why 130 plus in 2026 is plausible, and what would have to happen for that thesis to die. This is a new channel, currently at just 30 videos. In the 5th video, I explain at what point I would start thinking about selling my silver. If you haven't seen it, I'd recommend watching it after this one. Now let me tell you a quick parable. You pull into a gas station. The big sign out front shows a price per gallon. But when there's a real shortage, a second price appears. The price under the table. The price for whoever needs to drive today, not tomorrow. So I'll ask you, what's the real price? The one on the sign, or the one paid by whoever needs the physical product to keep moving? Quick disclaimer, this is educational content. This is not financial advice. It's analysis of public data and scenarios. My 130 plus thesis rests on 3 structural drivers: recurring deficit, the market keeps tightening, physical investment returning, especially in the West, the system's plumbing, inventories, flows, contracts becoming more sensitive to shocks. 2 price triggers: re-entry of flows, ETF retail during moments of volatility, dislocation between the screen price and the cost of acquisition, physical premium, direct contracts. One real break, and I'll give it the respect it deserves. Substitution, thrifting, especially in solar as the industry tries to replace silver with copper. Driver number 1, the deficit isn't a headline, but it is gravity. Most of YouTube talks about price. I prefer to talk about gravity. According to projections published by the Silver Institute with analysis from Metals Focus, 2026 is on track to be the 6th consecutive year of structural deficit, with an estimated shortfall of approximately 67 million ounces. And here's a detail a lot of people miss. A deficit doesn't mean silver ran out. It means the balance is being maintained by burning through above-ground stockpiles. Bars, inventories, metal that someone was holding. A deficit is like spending more than you earn. You can manage it for a while as long as you still have savings. The problem is savings aren't infinite. Let me explain this mechanically because understanding deficits is critical. When we say 2026 will have a 67 million ounce deficit, what that means is demand exceeds supply by that amount. Total mine production plus recycling equals supply. Total industrial demand plus investment demand equals demand. If demand is 67 million ounces higher than supply, where does that 67 million come from? It comes from above ground stocks, from COMEX inventories, from LBMA vaults, from private storage, from ETF redemptions if they happen. The metal physically moves from storage into consumption. And once it's consumed in industrial applications, solar panels, electronics, it's not coming back. It's gone. So each year of deficit permanently reduces the available pool of metal. Now, 67 million ounces might not sound like much. It's about 8% of total supply. But remember, this is the 6th consecutive year. If you add up 6 years of 60 to 100 million ounce deficits, you're talking about 400 to 600 million ounces that have left above ground stocks. That's the equivalent of draining all of COMEX and LBMA inventories combined. Twice. And within the same set of projections, 2026 would see total production in the range of approximately 1.05 billion ounces, with modest growth, and physical investment projected to rise to approximately 227 million ounces. That investment number matters, because investment is the impatient buyer. Industrial buyers purchase when they need to. Investors buy when they wake up. Let me break down that investment number because it's the key variable. 227 million ounces of physical investment. That includes coins, bars, ETF inflows. Compare that to industrial demand, which is around 600 million ounces, and moves slowly. Industrial buyers have long-term contracts. They plan purchases quarters in advance. They're not reacting to headlines. But investors? Investors are volatile. They can go from 0 to 200 million in months if sentiment shifts. In 2024, investment demand was weak, maybe 150 million ounces. In 2025, it picked up to around 200 million as price started moving. If 2026 hits 227 million, that's a 13% increase year over year. And if sentiment really shifts, if we get a retail rush, investment could spike to 300, 400 million. That's what happened in 2011 when silver went to 49. Investment exploded. That's the impatient buyer waking up. Driver number 2, the West hasn't hit the button yet. What stands out to me in the 2026 read is one implicit phrase: retail investment largely compensating, meaning physical investment can sustain demand even as industrial demand fluctuates. And at the same time, you have the thermometer of the paper silver market, SLV. The iShares Silver Trust page itself shows current NAV and 52-week range, reflecting the scale of recent moves and how sensitive prices are to flow. Theater parable. The stage is price. The audience is flow. When the audience stands up all at once, it doesn't matter how small the stage is, it shakes. If 2026 holds a deficit and the West reactivates physical ETF buying with force, price doesn't need to rise slowly. It can jump. Let me explain why Western buyers matter disproportionately. Asian buyers, Chinese and Indian physical demand, are steady. They buy consistently. They accumulate gradually. Western buyers are different. They're momentum-driven. When price is flat or falling, they don't buy. But when price breaks out, when it makes new highs, when financial media covers it, they pile in. That creates explosive demand surges. SLV is a perfect proxy for Western sentiment. When Western investors want silver exposure, they don't typically buy coins or bars. Too much friction. They buy SLV. And SLV creation is fast. An authorized participant can create 10 million shares in a day if there's demand. Each share represents roughly 1 ounce. So 10 million shares equals 10 million ounces of physical silver that has to be sourced and deposited with the custodian. In 2020, when silver rallied from 14 to 30, SLV added 150 million ounces in 6 months. That's the audience standing up. That's the stage shaking. If 2026 sees a similar surge, if SLV adds 100 million plus ounces, where does that silver come from? It has to come from available stocks. And if stocks are already depleted from 6 years of deficits, sourcing becomes harder. Premiums spike, and paper price has to rise to attract selling. The jump. Why 130 might be easier than it looks. The biggest analytical mistake is assuming price moves linearly. In tight markets, price functions like an urgency auction. When a buyer who needs the metal shows up, they pay the premium, not the benchmark. That's the rubber band logic. One hand is the screen price. The other is the real-world cost of acquisition. The more it stretches, the higher the risk of a sharp snap. My 130 thesis doesn't require a new world. It requires one of 2 scenarios. Investment flow comes back strong, plus supply doesn't respond fast enough. Deficit continues. Or physical premiums, direct contracts increase, and the benchmark chases them higher. Let me walk through scenario 1. Investment surge. Say 2026 Q2, a geopolitical shock happens. Taiwan tensions escalate. Middle East conflict intensifies. Currency concerns spike. Western investors suddenly want safe haven assets. They rush into gold and silver. SLV sees $1 billion of inflows in a week. That's roughly 12 million ounces that have to be sourced. Where does it come from? COMEX registered is at 30 million ounces, but most of that is already spoken for, held by specific entities not freely available. Maybe 5 to 10 million ounces are truly available for ETF creation. The AP tries to source. They call bullion banks. Banks check vaults. Availability is tight. Premiums over spot jump from $2 to $8. The AP has to pay. That $8 premium feeds back into the ETF NAV. SLV starts trading at a premium to NAV as demand exceeds the AP's ability to create shares fast enough. Meanwhile, on COMEX, specs see the move. They start buying futures. Open interest jumps. But futures also create delivery obligations. If even 5% of contracts demand delivery, that's another 10 to 15 million ounces needed. The system is stressed. Price gaps from 80 to 90 in days, then 90 to 100, then 100 to 120. Then the question becomes, where's resistance? Is there a ceiling? Psychologically, 120 was the recent high. Some people will sell there thinking it's the top. But if the fundamental driver, the investment surge, The physical tightness hasn't resolved. 120 becomes support, not resistance. Price pushes through to 130, 140. That's how tight markets work. Resistance levels that seem solid evaporate when the underlying driver is strong. Scenario 2. Physical premium dislocation. This is the gas station parable. Say COMEX silver quotes $90, but in Shanghai, physical is trading at 110. In Mumbai, it's 105. In London, allocated bars are 100. The paper price is 90, but the physical market is pricing $15 to $20 higher. That dislocation can't persist indefinitely. Either physical premiums collapse, meaning supply improves and stress eases, or paper price rises to close the gap. If stress continues, if inventories keep draining, paper has to chase physical higher. Why? If paper is 90 and physical is 110, arbitrageurs should buy paper, demand delivery, sell physical, capture the spread. But if delivery is difficult, if COMEX is slow-walking requests, if bars aren't available, arbitrage doesn't work. And that forces paper price up, from 90 to 95 to 100 to 110, chasing physical. When paper catches physical at 110, does it stop? Not if physical keeps moving. If demand continues, if industrial buyers and investors keep pulling metal, physical might go to 120, 130, and paper follows. That's the benchmark chasing acquisition cost. That's how you get to 130 plus without needing dramatic new stories, just continuation of existing stress, the honest break. Solar trying to move away from silver. Now I'll be fair. There is a real break, and it deserves to be taken seriously. Recent reporting shows the solar industry accelerating its shift toward copper and hybrid solutions because silver costs have risen sharply and are squeezing module manufacturing margins. This means industrial demand could be less explosive than some older models assumed. Let me give you specific numbers on this because it matters. Currently, solar consumes roughly 130 million ounces annually. That's about 15% of total demand. Each solar panel uses about 20 grams of silver on average, but manufacturers are developing copper paste alternatives and hybrid designs that reduce silver content to 15 grams or even 10 grams per panel. If successful and scaled, that could reduce solar silver demand by 25 to 50% over 5 years. 50% reduction in solar demand would free up 65 million ounces annually. That's almost exactly the size of the projected deficit. So if solar substitution succeeds, it could eliminate the deficit entirely. That's the break. That's what could cap prices and prevent 130 from happening. But here's the nuance. Substitution isn't a light switch. It's engineering, yield, reliability, scale, and certification. It slows the pace, but it doesn't erase the deficit overnight. Parable. You can swap out the plane's engine in the hangar. Mid-flight, you still need the engine you have. Solar manufacturers can't just flip to copper overnight. They have existing production lines, existing contracts, existing certification requirements. The transition takes years. And even as solar reduces silver content, other applications are growing. EVs use silver. 5G infrastructure uses silver. Medical applications use silver. So while solar might go from 130 million ounces to 90 million over 5 years, other applications might grow from 50 million to 90 million. Net effect, demand stays elevated. The deficit persists, just smaller. But big banks don't see it that way. Perfect. If you look up bank forecasts, you'll find quite conservative numbers. For example, JP Morgan's public read calls for a 2026 average around $81 per ounce. That doesn't refute 130. It just proves one thing. Averages hide peaks. A year can average 81 and still spike to 130 plus if there's a flow shock, a geopolitical event, stress in the plumbing, or a rapid repricing. And the LBNA itself publishes aggregated analyst forecasts, useful for seeing the spectrum of consensus, not for calling the top. Ocean parable. The average wave height doesn't show you the wave that flips the boat. If 2026 averages 81 but spikes to 130 in Q3 during a crisis, both can be true. The average is 81. The peak is 130. And if you're trying to position for upside, you care about the peak, not the average. My thesis in 60 seconds. The triangle model. I call this the 2026 silver triangle. Deficit gravity, 6th consecutive year. Investment flow returning. Estimated 227 million ounces. Narrow plumbing, small market, fast adjustment when flow comes in. When all three align, 120 isn't the destination, it's a stop along the way. 130 plus becomes plausible in 2026 if you get Western ETF retail re-entry paired with a macro risk narrative and supply responds slowly as the projections suggest. What would kill this thesis? Here's the checklist of what would take 130 off the table. Solar substitution accelerating much faster than the market expects. Recycling rising aggressively and sustainably, relieving the deficit. Investment flow fails, the West doesn't enter or exits quickly. Monetary tightening, real yields drain liquidity and suppress metals for longer. If 2 or 3 of these happen simultaneously, 130 becomes much less likely. Let me be specific about what each killer would look like. If solar substitution accelerates, we'd see announcements from major panel manufacturers. First Solar, LONGi, Jinko Solar, saying they're converting 50% plus of production to low silver or copper-based paste within 12 months. That would be ahead of schedule. That would signal the transition is faster than expected. Industrial silver demand would visibly decline. If recycling surges, we'd see scrap supply data showing consistent increases. Maybe recycling goes from 180 million ounces annually to 220 million, 250 million. That extra supply fills the deficit, prices stabilize, the squeeze eases. This would likely be driven by high prices making recycling economically attractive. If investment flow fails, we'd see SLV holdings flat or declining. Retail coin sales weak, ETF outflows. That would mean Western investors aren't buying the breakout, they're fading it. Without that investment surge, the demand side weakens. Price struggles to break out sustainably. If monetary tightening persists, we'd see real yields continuing to rise. Fed holding rates high, inflation falling but nominal rates not coming down. Real yield on 10-year treasuries going from 2% to 3% or higher. In that environment, non-yielding assets like silver struggle. Capital flows to yield. Precious metals get sold. That macro headwind could cap silver below 100, let alone 130. Now let me address timing and positioning because understanding the thesis isn't enough. When do you position? How much? What's the risk management? The triangle model suggests setup is in place, deficit, investment flow potential, narrow plumbing, but timing is uncertain. The spike could happen Q2, Q4 or not until 2027. You can't know. So how do you position? I'd suggest thinking in layers. Core position in physical silver, 10 to 20% of precious metals allocation. This is long-term, buy and hold, don't trade it. Volatile position in ETFs or miners if you want leveraged exposure to a spike. But size this appropriately. If you can't handle 50% drawdowns, don't play, because even in a bullish setup, corrections will happen. And watch your catalysts. What events could trigger the investment surge? Geopolitical shocks, currency crises, banking stress, fiscal crisis. These are the sparks that light the fuel. You can't predict them, but you can be positioned when they happen. That's the advantage of being early. You get to buy the setup before the catalyst. After the catalyst, everyone sees it and prices adjust. The mistake most people make is waiting for confirmation. Waiting until silver breaks 100, 110, 120. Then they buy thinking it's safe. But by then the easy money is gone. Risk reward is worse. You're buying at the high, better to position in the setup, except that you might be early, except that you might sit and draw down for months. But if the thesis is right, being early beats being late. So this isn't back to 120. The question is the market structured for spikes? And is the psychological ceiling actually 120 at all? My thesis, 130 plus in 2026 is plausible if flow returns and the deficit keeps doing what gravity always does. If you found this useful, consider subscribing so you don't miss new updates. Leave a comment. I'd love to hear your take and what price level you think silver hits this year. Worth repeating, nothing here is a recommendation. It's a reading of the system. Because in the end, you don't buy the sign, you buy the gallon. Thanks, and see you next time.